Welcome back to the Perpetual Pip, everyone. This is your host, Will Gomez, and it's time to continue with another edition of Trading 101. Now, today's lesson for Trading 101 is going to be focused more on what's known as spatial intelligence. We're going to be working on a technique which is how to think more in a pattern mindset. So far, we've been talking about the different aspects, the different concepts in market theory, and we're going to continue to build on everything that we know by discussing another topic, how to identify consolidation. Now, as you've come to expect by now, what I'm looking to accomplish with these lessons is to help give you a functioning understanding of what's going on in the markets, and then we're going to lead into the different ways to actually trade it. But it is absolutely imperative for traders to be able to, or aspiring traders to be able to fully understand the concepts. You can't call yourself an auto mechanic if you don't understand how a combustion engine works. You can't call yourself a professional athlete if you are not fully versed in the rules of your sport, or whatever the case may be. So as a result of that, you can't be a physician without having attended med school and having a deep understanding of the human anatomy and the different functions and systems that exist therein. So that's what we're looking to do here with these lessons. Get a functioning understanding of the beating pulse of the market before we do anything silly and jump into positions being driven by emotion, being driven by maybe illusions that we've created for ourselves about our future financial potential. Can massive wealth be accumulated in these markets? Yes, but only by those that understand how it works. So enough about that. I'll get off the soapbox on that. Let's talk about how to identify consolidation. Now, so far we've established that the market is able to move upwards and downwards, right? However, despite the fact that we understand that the market moves in these neat or in these nice A, B, C, D waves, right? In an uptrend, the market moves from a low to a high, A, B, C, D. In a downtrend, A, B, C, D wave, right? Elliott wave, Fibonacci wave pattern. This is a very textbook way of understanding how the market functions, right? We have to work at bridging the gap, looking at actual charts and understanding that this is the general framework that governs everything, but there's a little bit of noise that occurs in the actual charts. So once we have this framework, we can kind of make sense of the apparent chaos. It's going to be the same thing when it comes to a period of indecision. Every now and then, although the bulls and the bears are fighting for control of the market, every now and then there aren't clear victories, there are draws, right? And that's what we want to understand. So the third option that the market tends to move in, right? And the reality is I phrase it this way because a lot of traders can come across what could be potentially confusing information. So the reality is that the market can only move in two directions. It can only move upwards or downwards. However, for the sake of argument, let's say that there's a third option, and that's lateral movement, no direction at all. Okay? This movement that the market, or lack thereof, that the market is making is known by several different names: accumulation, sideways movement, bracketing, consolidation, and of course being range bound. These are some of the different terms that you're going to hear when you may come across different presenters, analysts, financial consultants, whatever the case may be. They may use this lingo, all right? And I want to prepare you so that you know what that's about. However, for the purposes of my discussions, my live sessions at perpetualpip.com, where we do live trading, what I typically refer to it as will be either consolidation or sideways movement. All right, that's the most common that I use. And effectively, all we're talking about is a period of indecision where the market doesn't know what it wants to do. So it creates a relatively equal range between a level of resistance and a level of support. And all it's doing is it's ping-ponging back and forth, up and down between this established range. All right? So this is pretty much what you'll learn from the big institutions and what they charge thousands of dollars to be able to teach you, that every now and then the market creates situations like this. The problem with a drawing of this nature, it's designed for simplicity to get you to understand the concept, but the inherent issue is that traders, new traders to be, it's normal, right? You're getting ready to take your money into your own hands and try to get it to work for you. So what we tend to do is be very literal. all right? And when we go and we try to identify these consolidation ranges, we make a lot of mistakes. So we want to kind of polish those out of the way and make sure that we are doing this appropriately. How? Well, there are these words, right? And you're going to see a lot of overlap when you're working with markets and the lingo therein, the terminology therein. There's a lot of overlap. We're going to get into that in other videos as well when we start talking about entry orders and actually placing trades into the markets. There's a lot of overlap or reuse of the terms. And that's because a lot of the times they are referring to generally the same thing. So we need to kind of back off a little bit on how literal we're being. The words support and resistance have been used. Again, yes. Now, unlike what we've learned before, right? Unlike what I like to call formal support and resistance, if you will. We've talked about that in the past in previous videos. If not, be sure to check it out. Either here on the YouTube channel or at perpetualpip.com. I have a section where it says Learn to Trade, and that is where you'll be able to access these tutorials also completely free, all right, on how to be able to understand how the market works. So we've talked about this in the past, and when we're talking about normal or formal support and resistance, we understand that we start at the current candle and we work our way backwards in time. For normal or formal resistance and support, resistance is equal to higher highs from the current candle and so on and so on, and support is equal to lower lows from the current candle. However, when we're talking about consolidation or sideways movement, we're not talking about that. We're not talking about a specific higher high price or a specific lower low price. We're talking about an average ceiling that the market can't seem to get past at this moment in time, or during these periods, during these candles. The market is exhibiting some symptoms of being unable to penetrate this ceiling, or unable, the ceiling of resistance, or unable to penetrate the average floor of support. So that is why it's called range bound. It's just kind of stuck inside of an average area. Here is a chart, right? Now, again, big picture view. When determining trend direction in one of our previous videos, we understand we want to take a big picture view to understand what, to thoroughly appreciate what the market has been doing, understand it, and be able to project with a reasonable degree of certainty what the market will do. So we always identify trend direction using our trend lines. Now, even though we can perceive generally who's in charge at any given point of time with the trend lines, we can also see that during the course of the trend, there were periods where the market didn't know what the heck it wanted to do next. It's this that we consider to be consolidation. This sideways movement is not a rare phenomenon whatsoever. This is actually the norm. The market is presumed to be sideways a vast majority of the time. Some people speculate anywhere between 70 to 80% of all market behavior is actually sideways. Why would I say something like that? I've looked at some of these charts, and these charts clearly show me the market making higher highs and higher lows, or lower lows, lower highs. Look at the one that you're showing me right now. And I would say, yes, that's absolutely true. But believe it or not, whether you realize it or not, if you zoom out far enough, that quote trend that you're looking at is more than likely part of a larger time frame's consolidation range. It's probably something like this inside of a larger time frame, and all you're seeing is this move right here. It's fractal, right? There are waves within waves. There are 24 hours in one day. There are 60 seconds in 1 minute, 60 minutes in 1 hour. We kind of understand this instinctively now, but we take for granted the fractal, the particles that exist therein, right? So it's the same thing for the market, which literally measures price action against time. So when it comes to properly identifying the consolidation range, oh man, I'm starting to feel overwhelmed. How can I possibly understand this? Relax. Okay, this is more of an art form than an exact science. So you're just going to do this to the best of your ability. You just have to train your brain that you are not looking for extremes. First things first, if you took a look at that chart and you saw that the market, or when you're live, right, when you're at the current candle, you'll be able to see what the market has been up to so far. And you'll be able to see that it's either created higher highs or created lower lows, or it's currently failing to do so. So that's great. Instinctively, spatially, we can see, you know what, this isn't doing what it was doing before. You're already up to the right mentality. Fantastic. Now, we don't want to then panic though when we see that the market is not doing what it was doing before, because this is what causes a lot of traders to unnecessarily fiddle with their position. Instead, what you want to do is recognize consistency is where it's at, right? That's what a trend represents. A trend represents overall the market is consistently making higher highs, higher lows, lower lows, lower highs. So we're going to do the same thing when we identify that the market is no longer doing that. We are not trying to identify extremes, right? We're not going to go and do something like this, where we say, okay, well, that is the highest point that I can tell that it's not making higher highs or lower lows. That's the highest point that it's been able to make. This is the lowest point that it's been able to make. That must be my range. No, wrong. Why? Because it doesn't accurately acknowledge what the market has been doing consistently, right? It just shows the market was able at one point in time to make it this far, but very rarely, right? That's not what we're looking for. We're not looking for the exception. We're looking for the rule here to be able to have our trades be equally consistent. So instead, we want to identify an average ceiling of resistance, right? An average with a single line. Try to get as many touches as possible. We want to do the same thing for support. With a single line, try to get as many touches as possible. Do not be afraid to be conservative with this. It's going to pay dividends when you actually get to the business of trading it. Again, just so everyone is clear, for the purposes of this video and all the videos that precede this, we are still talking about how the market works. There will be separate videos later on which will enumerate the different strategies on how to go about taking advantage of this. Here's that same chart just slightly blown up, right? And what I did was I wanted to show some examples of conservatively identifying the average of resistance and support. You want to make sure that you are seeing the market consistently, effortlessly making it to this average level of resistance and support. Once you have achieved that, you know that you have an accurate consolidation range. Okay? The average. These are the three range sizes that exist, that I've found in my market experience exist. Okay? You have small consolidation. Small consolidation, or tiny consolidation, if you will, is a range where I would say at least 59 pips rather. The average distance of resistance to support is 59 pips or less. Okay, these types of ranges don't really take that long to form, especially, and most likely they're going to form on smaller time frames, but they don't take that long to form at all. All right, so when it comes to a small consolidation range, I'll tell you right here, right now, I'm not looking to mess with it as long as it remains within that. A small consolidation range, as far as I'm concerned, is no trade zone, not touching it. Instead, what I'm going to look for is something known as a breakout, where the market forms a decision candlestick formation. We talked about those before, where I'm getting a signal of I'm going up or I'm going down decisively beyond the range. So that candle body has to close 50% or more above resistance bullish, or 50% or more beyond support bearish, before I'll consider that the market is seriously done with that range. That's a sign, right? We'll talk more about that in strategy videos. That's the only type of trading that I'm going to be doing when dealing with a small consolidation range. Large consolidation is also commonly taught, right? Consolidation ranges that are greater than 150 pips in size, this becomes the more relaxed type of consolidation trading. When you identify a consolidation range of that size, you have more than likely, because the average daily trading range, or how many pips any given currency tends to move during the course of a single day, doesn't tend to be super large. It's sometimes in the triple digits, but it doesn't tend to be in the thousands unless you're talking about like the US dollar, Mexican peso, or something like that. But again, very, very rare instances. So what you have is the market may take a day or longer to make it from one extreme to the other, resistance to support, or vice versa. And so you have enough time to A, observe an entry, qualify an entry, and B, manage your position from the extremes. What you're looking to do is you're looking to buy at support, at a bullish candlestick formation, sell at resistance. Right? This is very relaxed consolidation trading. Remember, consolidation is just another type of pattern. The market has exhibited signs that it has some difficulty leaving this range, and I'm going to continue to treat it as such. as long as it remains in the range. Once the market tells me, okay, I'm done with this range, we can proceed differently, right? Maybe taking a look at an A, B, C, D Fibonacci retracement or something like that. But as long as the market's in the range, our focus can become a little bit more myopic just on that range and how to deal with the range conditions, right? I read this out of order on purpose, and that's because there are situations, and this is something that I do exclusively in my sessions. There are consolidation ranges that are not really that big enough for us to trade with a soothed brow, very relaxed, if you will, like large consolidation. But we're also not talking about a microscopic range either, right? Where it's less than 60 pips, more than likely it's going to be on a smaller time frame, way too erratic, right? There's just not enough room to maneuver. So for small consolidation, that's why I generally disregard that as a tradable currency. I'm done with it as soon as I see it. Medium consolidation is something that I've recently added to the roster. These are ranges that are not exactly that small. They do appear to yield a lot of opportunity. There's still a lot of opportunity on the table, but we have to be very careful how we trade it. So in my live sessions using my system, the Perpetual Pip Snapper, we look to be able to participate at the edges, but we use the system to help guide us into an entry that we can then maintain with that system, locking in profit as we go. So I'm looking to try to identify the range on any time frame. If it's at least 60 pips in size, then I'll go down to a tiny erratic time frame, like a 10-minute, where I can call an earlier entry and maintain that entry, locking in profit as it goes, but still looking to remain actively able to exit very quickly. All right, now that I may not include in future videos, just full disclosure, because it is something proprietary that we do during the sessions. However, I did want to put it on your radar out there, and just in case you did decide to join us in one of our sessions, you are aware of its existence and you're not blown away or caught by surprise. Wait a minute, you said in your video that this range is not 150 pips. Why are you trading it? It's not breaking out. Okay, so just keep that in mind moving forward. With that said, now we have a functioning understanding of what consolidation is and how to identify it correctly. So we're getting slowly but surely closer into the discussion on how to be able to trade effectively in the live markets. Our next video is going to be on the different types of orders, how to actually enter into positions using our broker platforms. Now, I'll do my best to incorporate the different types of orders. The platform that I tend to use is TradingView. But there are different platforms out there that will give you different options. So we're going to talk about what these orders are, and then it's realistically going to depend on what trading platform or broker you decide to go with, what options will be available for you, but I will keep you as informed as possible. Thanks again for watching. I hope that you enjoyed this, and if you did, be sure to like and subscribe for more additional free content. Either on YouTube, or you can access this, of course, as I mentioned, on the actual website, perpetualpip.com. Once you've learned enough and you feel like you understand how this market works, be sure to come see us in the live sessions. This has been Will Gomez, FX Showtime, once again for Perpetual Pip. Thanks again, and take care.